G'day everyone, Damien here again, and today we're going to talk about interest rates, one of the greatest fears that a lot of property investors have. So, what could go wrong with interest rates? Well, the big problem with interest rates is that they could take off and go through the roof. And of course, if you're holding a large portfolio and you're on a variable rate, then that could very quickly turn a positively geared property into a negative one, creating a big problem for you. So, how do we deal with that? Well, the first thing you have to understand is that the banking system in Australia has changed. You might have heard all the horror stories about the late 80s and early 90s where interest rates hit ridiculous levels like 18-19%, and that did happen. But after that, something very significant occurred and it reduced interest rates quite dramatically, and that was the Reserve Bank being made independent, well, having an independent board to direct it what to do with interest rates. Now that independent board controls the setting of the rate rather, and they tell the Reserve Bank what the rate should be. Now, their brief to do that is to keep inflation between 2 to 3%. So, if inflation's taking off and the economy is too strong and getting out of control, they'll put the interest rate up. Now, as the Reserve Bank is the body that provides money to the normal banks who lend money to you, well, the Reserve Bank will put the interest rate up. The normal banks will then put the interest rate up on you. You'll then have less money in your bank account, you'll spend less money, and that will de-stimulate the economy. Conversely, if the economy is stalling, they'll drop the interest rate, the banks will drop their interest rate, you'll have more money, you'll spend it, and that'll stimulate the economy. Ever since that system's been in place, we've seen interest rates plummet and then the base rate staying at around the 5% mark. Of course, right now, interest rates are ridiculously low, and it's a wonderful, wonderful time to have investment portfolio because you can borrow money so cheaply. But what happens when interest rates go up? Well, the first question we have to ask ourselves, are they going to go up in any major way, and how can we tell? Well, we can tell what interest rates are going to do by looking at the fixed rate, and in particular the 3 and 5 year fixed rates. Now, if you're on the fixed rate and the Reserve Bank starts putting interest rate up, can your bank put your interest rate up on you? The answer, no. That's the whole point of a fixed rate. So the banks want you on the variable rate so they don't carry any risk. If you're going to insist on being on a fixed rate, then they're going to have to cover their backsides by making sure that that fixed rate is at a level that they can handle. Now, the banks employ hundreds and hundreds of economists to study the economy and try and predict what's going to happen with the economy, and in turn what the Reserve Bank's going to do to them with the base rate. If you want to know what all those economists are thinking, all you have to do is look at the difference between the fixed rate and the variable. If the fixed rate is much higher than the variable, then that tells us that the banks think the interest rate is going up because they want to keep a buffer between where you are on the fix and where the variable is, so that as the variable comes up, they'll still make a profit. Conversely, if the fixed rate is about the same as the variable, that should tell you that rates are going to stay the same for a long period of time. And if in the very rare occasion that the fixed rate is indeed lower than the variable, that should tell you that the rate's going to come down. Now, all you need to do if you're worried about interest rates going up is look at the 5 year fix compared to the variable, and that should give you some comfort as to what may occur. Lastly, you've got the option of how to protect yourself from interest rates going up, and there's 2 things you can do. The first thing you should do is make sure that you have a portfolio that is positive cash flow to start with. If it's already negative and interest rates start going up, then that pain's only going to get worse. If it's positive, then you've got some room to move if the costs start going up through paying more on interest rates. Of course, you can always fix your rate if you want to, but the fixed rate will cost you more than the variable rate over time. Now, that extra amount of money, if you think about that as an insurance policy premium, i.e. if there was an insurance policy you could pay to make sure that your interest rate didn't go up, would you pay it? And in that case, you probably say yes. Therefore, it's fine to be on the fixed rate if you're seeing it in that frame of mind. And then finally, you really just want to make sure that you always maintain a large cash buffer. And I say to people, at least 3 months mortgage repayments per property, sitting in a cash buffer, usually an offset account, and if you're living in your own home, that offset account should be against the original mortgage on your loan, because that particular loan is not tax deductible. Now, if you've got that sort of cash laying around, then interest rates start taking off. Well, that cash can act as a buffer and start absorbing that extra money you have to pay until such time as you can make an informed decision in regards to your portfolio. Maybe you'll decide to sell, maybe you'll refinance, but you won't get caught out. Remember, cash is king. You want to have plenty in the bank. So, interest rates. Will they take off again like the 80s and 90s? No, not unless they take away the independence of the Reserve Bank. What can we do to predict rates? Look at the difference between the fixed and the variable rate. What can we do to protect ourselves from them rising? Consider fixing your rate and always maintain a large cash buffer. That's it from me today. I hope you got something out of that. If you did, please share, please comment, please like. And until next time, I'll say goodbye. Cheers.